Imagine, like, finding an old winter coat, checking the pocket, and pulling out a lottery ticket you bought years ago for, say, $217,000.
I mean, that is a pretty expensive lottery ticket to just forget about.
Right, right, it is. But imagine you pull it out, and suddenly it is worth $80 million.
Oh, wow. Yeah, that would definitely change your day.
It would absolutely warp reality.
Yeah.
And that is, believe it or not, the kind of massive asset hiding deep inside the balance sheet we are looking at today. Welcome to today's deep dive. We are jumping into a dense 60-plus page SEC filing so you don't have to.
Yeah, specifically, we're looking at the Q1 2026 Form 10Q for OFS Capital Corporation.
Exactly. Our mission here is to decode the hidden machinery of middle market finance. We're going to explore how a business development company, or a BDC, navigates a really turbulent first quarter of 2026, balancing these mind-boggling paper wins against some very real losses.
And this document is important because it provides a pristine look at the extreme forces hitting middle market lenders right now. I mean, OFS Capital sits right at the intersection of shifting SOFR interest rates from the Fed, sticky inflation and global instability.
Right. From the Middle East to South America, it's all in there.
Yeah.
Okay, let's unpack this. BDCs basically act as the financial shock absorbers of middle market America.
That's a good way to put it. They provide the capital that regular banks just won't touch.
Yeah. But right now, the macroeconomic road is incredibly bumpy. To understand just how bumpy, we really have to look at the scoreboard. And for a BDC, that means looking directly at their net asset value, or NAV.
Right, the NAV. And it took a noticeable hit this quarter.
A huge hit. Going into 2026, OFS's NAV was sitting at $9.19 per share. But by March 31st, it had dropped to $8.16.
Yeah, a full $1.03 wiped out in a single 90-day window. That is a brutal compression.
It really is.
Yeah.
And looking at the exact numbers, OFS reported a net loss on investments of $13.9 million for the quarter.
Which is significant. Now, they did manage to generate 18 cents per share in net investment income, and they distributed 17 cents to you, the shareholder.
They are still paying out.
Right, they're pushing cash out the door, but the overall portfolio value is undeniably shrinking.
So where is that loss actually coming from? Because it isn't from, like, traditional corporate loans going bad across the board.
Right. No, it's not. And what's fascinating here is the primary culprit for the drop. It's their structured finance securities.
Specifically collateralized loan obligations, right?
Yes.
CLOs.
Exactly. Out of that $13.9 million loss, $10.3 million came directly from realized and unrealized losses in these complex subordinated CLO notes.
Wow. So almost the entire drop is localized in that one bucket.
Yes, and we need to understand how the architecture of those CLOs exposes OFS to such outsized volatility. So a CLO is basically a bundle of corporate loans packaged together and sliced into different risk tiers.
We call those slices tranches, right?
Right, tranches. Now, OFS doesn't hold the safe senior slices at the top of that bundle. They hold the subordinated notes. They hold the equity tranche.
Okay, let's break down that waterfall structure.
Mm-hmm.
How does holding the equity tranche functionally work when things get rough?
Well, in a CLO waterfall, the underlying loans generate interest payments. The highest rated senior tranches get paid first. They're at the top of the waterfall.
Makes sense. So they get the safest first drops of water.
Exactly. And the subordinated tranche gets whatever's left over at the very bottom. The trade-off is simple, really. The subordinated slice offers the absolute highest potential yield, but it also absorbs the very first dollar of any losses.
So it acts like the crumple zone on a car.
That is exactly it. If even a small percentage of the companies in that loan bundle start missing payments, or if the market just prices those loans lower due to, say, economic anxiety,
the value of that bottom slice just collapses.
Disproportionately, yes. The senior debt holders might not even flinch, but the subordinated holders, like OFS, take an immediate leveraged hit.
Which results in that $10.3 million drag on the NAV. But wait, there's another issue here, right? Because the performing income yield on their interest-bearing investments also dropped.
Yeah, it dropped a full percentage point from 13.5% down to 12.5%. And that is largely driven by the Federal Reserve cutting interest rates.
Okay, I have to push back on the mechanics of that because the filing says 94% of OFS's loan portfolio is a variable rate.
Correct. Most of it is tied to SOFR, or the prime rate.
Right. So if 94% is variable rate, shouldn't they be protected? I mean, why does a drop in interest rates hurt them so badly here?
Well, it's because variable rates act as a one-way shield. They protect the lender from losing value when rates rise, but they leave the lender's income completely exposed when rates fall.
Oh, I see.
Yeah, so when the Fed cuts rates, SOFR drops. And the minute SOFR drops, the actual interest payments those middle market borrowers owe to OFS decrease instantly.
So the revenue pipeline just narrows overnight.
Precisely. The cash coming through the front door shrinks, but OFS's own fixed operating costs don't drop at the same speed, so their margins get squeezed.
Wow. Okay, so the interest income is shrinking, and the subordinated CLO tranches are carving a massive hole in the NAV. You would naturally assume the whole portfolio is in deep trouble.
You would think so, yeah.
But here's where it gets really interesting. Sitting over in their equity bucket is a massive, almost unbelievable counterweight keeping the entire ship afloat.
Yes, they're a common equity holding in a manufacturing company called Fansteel Holdings, Inc.
Fansteel. And this brings us back to that lottery ticket analogy from the intro.
It does.
Because OFS Capital's initial amortized cost for this investment was just $217,000.
A tiny fraction of their capital.
Right. But its fair value at the end of Q1 2026, a staggering $80.43 million.
The multiple on that is just wild. It's roughly a 37,000% return on paper.
It's completely absurd. This single investment now makes up 26.1% of the entire portfolio's fair value.
And crucially, an astonishing 73.6% of OFS Capital's total net assets.
Nearly 3/4 of their net assets. Oh, and it also just paid them a rare $874,000 cash dividend in Q1, meaning a single quarterly dividend paid back their initial investment 4 times over.
Which is great for cash flow, sure. But if we connect this to the bigger picture, holding a single asset that constitutes nearly 3/4 of your net asset value introduces a profound structural fragility.
That's exactly what I was thinking. Isn't it insanely risky to have almost your entire net asset value tied up in a single unsellable asset? Because Fansteel is a private company.
Right, it's highly precarious, and we have to analyze how that $80 million number is actually generated. In accounting terms, this is what's called a level 3 asset.
Okay, what does level 3 actually mean for you, the listener?
It means there is no active open market for it. You can't just check a stock ticker. The valuation relies entirely on estimates based on unobservable inputs and internal modeling.
So basically an educated guess by their accountants.
Well, a very rigorous guess using enterprise multiples. They look at Fansteel's earnings and they apply a multiple somewhere between 5.0x and 13.75x.
That is a pretty wide range.
It is. And then they include discounts for it being a minority illiquid interest. The vital difference here is between paper wealth and cash liquidity. OFS has immense paper wealth in this asset, but zero immediate liquidity.
Meaning they can't just click a button and sell this asset for $80 million tomorrow morning to cover their debts.
Exactly. They are entirely dependent on that theoretical valuation holding up.
Okay, that transitions us perfectly into cash liquidity. Because since OFS Capital can't instantly liquidate an $80 million paper asset to pay its bills, they have to actively manage their own corporate debt to survive these headwinds we talked about earlier.
Right. They're essentially playing financial Tetris with their corporate debt.
Financial Tetris, I love that. And the Q1 filing shows some frantic financial reshuffling. In Q1 2026, they completely paid off a BNP credit facility.
Yep, cleared that out.
And they paid off the remaining $16 million of their unsecured notes that were due right then in February 2026.
Which required cash they needed to source from somewhere else.
Exactly. So to do that, they opened a brand new $80 million Natixis facility. Concurrently, they extended their Bank of California credit line out to 2028.
Though they did shrink the maximum commitment on that Bank of California line.
Right, they dropped it from $25 million down to $15 million. It's so relatable, honestly. It's like paying off a high-interest credit card right before the rate balloons, using a brand new home equity line, just to ensure you have financial runway until 2028.
That's a perfect analogy. And they shrank the California line because unused credit lines still cost money in commitment fees. They're optimizing costs.
Just stripping out the fat.
Right. But we have to elevate this to BDC regulations. The primary constraint forcing all of this meticulous maneuvering is the asset coverage ratio.
Right, the SEC rules.
Exactly. By law, BDCs must maintain a 150% asset coverage ratio to protect their investors. They have to hold $1.50 in assets for every dollar of debt.
And since their NAV drops so much, The asset side of that equation was shrinking dangerously fast.
Exactly. If they breach that 150% limit, they are restricted from paying dividends, which for a BDC is a death sentence.
So all this defensive maneuvering with Natixis and BNP, did it work?
It did. Despite the NAV drop, their treasury management kept the ratio at a healthy 154% at the end of the quarter.
354. That is only a 4% cushion. That feels incredibly tight.
It is tight. They are playing intense defense to ensure they don't breach regulatory limits. In fact, it was so tight that their external advisors actually agreed to waive a portion of their base management fees.
Wait, really? The managers took a pay cut?
Yeah, they dropped the fee to an annualized rate of just 1% for certain assets held by their financing subsidiary, just to help absorb the shock and maintain compliance.
Wow, when the management team voluntarily gives up their own fees, you know the macro squeeze is real.
Absolutely.
Okay, so OFS Capital has successfully bought themselves time until 2028 with their own creditors. But what about the companies they lend to?
Well, that's where we start seeing cracks in the ice. Those middle market borrowers aren't all so lucky.
Right. Let's dive into the non-accrual list. This is the leg of loans where the borrower has just straight up stopped paying interest.
Yeah. Correct. When a company hits a wall, they go on non-accrual.
And as of March 31st, 2026, OFS had $10.9 million of its portfolio at fair value sitting on non-accrual.
Yeah, and we saw some new distress this quarter.
Specifically, a company called JP Intermediate B, LLC, was added to this list in Q1. And it's not just paused payments either. OFS had to take a major haircut on another borrower, Redstone Holdco 2.
That was a tough one. They exchanged their old debt for new debt at just 63 cents on the dollar.
63 cents, so they took a 37% realized loss on the principal.
Yes, permanent capital destruction. Which brings us to the core issue. This raises an important question. Why are these middle market companies failing right now?
Right, and so what does this all mean for you, the listener? Like, why should someone prepping for a meeting or just trying to catch up on macro finance care about a few mid-sized loans going on non-accrual inside one BDC?
Because these non-accruals are the canaries in the coal mine for the broader economy. These defaults are the real-world consequences of the supply chain disruptions, labor shortages, and sticky inflation we mentioned at the very start of the document.
So they're feeling it before everyone else.
Exactly. Mid-sized companies often lack the pricing power of huge corporations. When persistent inflation drives up their labor and raw material costs, their margins shrink. They can't just hike prices 10% without losing customers.
And because their debt is mostly variable rate, like we discussed.
Right. The cost to service their loans remains historically elevated, so the cash flow simply isn't there. When middle market companies can't service their debt, it signals tightening economic conditions that eventually impact everything.
It ripples out to consumer prices, job markets, everything.
Mhm.
A middle market logistics firm doesn't just default in a vacuum. Before they stop paying OFS Capital, they freeze hiring, they lay off workers, they stop expanding.
Precisely. You are seeing the localized impact of macroeconomic policies playing out in real time, months before they show up in national unemployment data.
That is fascinating. So, to wrap up this deep dive, OFS Capital is really walking a massive tightrope right now.
A very precarious one, yes.
On one side, you have these brilliant, hyper-lucrative equity bets like Fansteel, single-handedly holding up the balance sheet with an $80 million valuation.
A literal 37,000% paper return.
Unbelievable. But on the other side, they are fighting this slow, painful drain. Structured finance losses from those CLO tranches, falling interest income from SOFR cuts, and struggling borrowers hitting the non-accrual list.
All while expertly shuffling their own corporate debt just to stay within SEC regulations.
It really highlights that reading a 10Q isn't just about accounting, it's about seeing the exact pressure points of the American economy laid bare.
It is, and it leaves us with one final lingering thought that I think everyone should explore on their own.
Oh, I like the sound of that. Lay it on us.
Well, we talked a lot about Fansteel and that level 3 asset valuation.
Right, the $80 million estimate.
So if a massive chunk of a financial institution's health and their regulatory compliance relies entirely on level 3 assets, meaning valuations based on internal models and unobservable inputs rather than an active open market, how much of our broader financial system stability is actually grounded in hard liquid capital, and how much of it is just a collective agreement on a theoretical spreadsheet?
Wow. A collective agreement on a theoretical spreadsheet. That is a little terrifying, actually. You just have to hope the math holds up when the pressure really hits the system.
You really do.
Well, that gives us all plenty to think about. Thanks for joining us on this deep dive.